Welcome to Biz Wire. I'm Joshua Linder in Beijing. With China's economic growth slowing down, the commodity-rich countries of Latin America may have to start looking to new avenues for sourcing capital. In recent years, Latin America has seen an increasing amount of Chinese interest, but a number of investors have been reconsidering following China's slowdown. From the Wall Street Journal, Pulitzer Prize-winning energy expert Daniel Yergin said that the China-fueled commodity supercycle has come to an end. The export-driven economies like Latin America in particular were able to bring in capital to drive resource exploitation. Mr. Yergin believes that the investment strategy will change. In the early 2000s, China saw potential in several industries within Latin America. These included Argentine and Brazilian soy products, Brazilian iron ore, Chilean copper, Peruvian metals, Uruguayan beef, and Venezuelan oil. China's total trade with Latin America and the Caribbean reached about $260 billion last year. The Asian giant is now the top trading partner of Brazil, Chile, and Peru. The president of the Inter-American Development Bank, Luis Alberto Moreno, predicts that the region will grow by 3% this year. That's down from estimates between 4.5 and 5% in the years following 2008. This is when a gigantic Chinese financial stimulus package fueled an infrastructure and real estate building binge that needed huge quantities of raw materials. With China's growth slowing, it's expected that exports from Latin America will be negatively affected. Financial Times correspondent David Pilling cites a Nomura report, which estimated that if China's 2014 growth rate fell 1 percentage point below the Nomura baseline of 6.9%, then Latin America's growth would decline by half a percentage point. The effects of China's slowdown may already be visible in Brazil. It grew by only 0.9% in 2012 and by only 0.6% in the first quarter of this year. This is after Brazil saw growth of 7.5% in 2010. The story in Mexico, however, is different. Labor costs in China have seen a dramatic increase over the past decade, while in Mexico, wages have stagnated. This has reversed a competitive advantage to Mexico. Mexico's relatively inexpensive labor costs are taking a page from China's playbook. The cheap labor is helping it emerge as a manufacturing and export powerhouse. In fact, HSBC has projected that the United States will be importing more from Mexico than from China by 2018. While this might seem good for Mexico's economy, there is a downside. The labor demand has increased, but wages haven't been making big gains. With depressed wages, there will be a slower expansion of Mexico's middle class. This means that the lower wage workers will have trouble improving their standards of living. Partly because of China and other Asian countries, Latin America has seen economic growth. After decades of economic instability, the region is experiencing relatively good economic growth figures. The United Nations says on average, annual GDP growth for Latin American countries will be 3.7% this year. You're watching BizWire on the Blue Ocean Network. All of the stories can be seen on our website, BONTV/biz-wire. In just a moment, we'll continue with more insight on the big picture of China's economy.